All right, hello everyone, and welcome you to the RetireReady Podcast. I'm David Nicholas here with Tim Hart. We're gonna have a great show in store for you today. Tim, this is your first time on the podcast, is that right?
Yes, sir, it is. Looking forward to it.
Tim's one of our financial advisors at the firm. Series 65, fiduciary, insurance. I mean, you really cover it all, and you work in client service, and you're one of our client service advisors. So great to have you on the show today. Today, we're talking about life insurance, and before I put you to sleep, this is going to be a good show. And I'll tell you, I've been pretty against life insurance as an investment. And you may see on TikTok and Instagram and YouTube, I would say that they're more insurance salesmen acting as financial advisors, trying to sell you life insurance as a way to replace your 401k or as a way to not save for retirement. And that it drives me crazy. Have you ever seen those influencers at all on
Yes.
social media?
I've had people call in. They say, hey, my son wants to look at doing this. And it doesn't really make a lot of sense to me of comparing that. Might work out for some people, but
Sure.
it's very slim opportunity there to really have that security and safety for the future.
Yeah, you're right, and it might. Like if you time it right, maybe there's a few. But the challenge is the costs that are involved with some life insurance policies, and a lot of them are hidden. They're hard to know. The contract costs can be pretty expensive, and so I've always said, if you're young, max out your 401k if you can, max out your IRA or Roth IRA if you're eligible, and then if you've already done those things, if you've already maxed out your 401k, if you've maxed out your Roth IRA, and you still have more money you want to put away, then maybe you can look at life insurance as an investment. But to me, it's the last thing on the block. But there are some really good use cases for life insurance. So, Tim, I know you're married. You guys don't have kids yet. Me and my wife, we have 3 beautiful kids, young kids. And I remember early on, and it's something you may want to think about too if you haven't already, but right before we had kids, I actually went out and got an insurance policy. And because the reasoning is not because if something were to happen to me, my wife would be okay and she would still work. And if you didn't have kids, it was really just making sure she would be okay. She could pay off the debt on our house. But I always recommend getting life insurance even before kids, because what if your health changes? What if you're 28 years old and you're married, but you don't have kids yet? And you say, I'll just put off getting life insurance until I have kids. Well, then, God forbid, you have a health issue that precludes you from getting life insurance, or you just have a health issue or surgery that makes your life insurance more expensive. We're going to dive into it, but how have you seen health impact costs and rates, and we're not even getting insured when it comes to life insurance?
Yeah, health can definitely give you a different rating on it, waiting for age. If, best time to get life insurance is last year. So any time before now is always better. But doing it now instead of saying, oh, let me look at doing it in 5 years or 10 years, like you said, have kids and then do it. It's a lot better to look at doing it as soon as possible. It's going to cost less. You're currently healthy. You're younger. They're going to give you better rates. Whereas, say you develop anything, or heaven forbid you have cancer and then you beat it, that's great. But just because you beat it doesn't mean your rates are going to be as good as if you didn't have it. It's still going to impact that to where, hey, that happened a couple of years ago. Are you getting checkups? Good. But it might make your premiums a little bit more expensive.
Yeah, so we're going to talk to both retirees and estate planning, tax planning here in a second, but this is kind of speaking more to younger investors, younger individuals, younger families. I always say buy term. So if you're young, in your 20s and your 30s, and you need life insurance to protect your family, you buy term. Meaning, I just want the most amount of life insurance I can get for the cheapest amount of monthly cost. I think the first policy I ever took out when I was probably late 20s was a $2 million term policy. I got to go back, but I think I paid less than $100 a month for this policy for 30 years. So when you think about that, if you can get that while you're young, lock it in for 30 years, let it line up into your 60s, if you can, or late 50s, early 60s, it's going to give you coverage, and it's going to give you the amount that you need. How much do you need? That's always a question, David. Well, how much life insurance do I need? There's a lot of math that can go in behind this, but you just have to think through this, right? If something were to happen to you, and let's just say you have kids, and if your spouse, whether she's working or not, if your spouse currently isn't working, or maybe she's working, but when you have kids, the plan is for her not to, do you want her to continue to be able to have that life? Or I'm talking to the guys here, to maybe their spouses that may or may not work, but how much life insurance is that going to take? And so generally, that could be anywhere between 7 to 10 times your income, right? So at a minimum. And so, if you're making $100,000 a year, you need a minimum of $1 million. We've even gone up to 15 times income, right? So if you make $100,000 a year, $1.5 million in life insurance. But it's good to sit down with an advisor to calculate what your needs are and really be able to go from that. I don't know if you have any color on that. I know most of who you're talking to are going to be either tax planning or more long-term care, which we'll talk about. But anything to add on that as far as how much insurance you need?
It's a great point of looking at that 7, 10, 12 times as much as your income, because some people just say, well, what are my debts? And I just want to be able to pay off the house and the car, college, whatever. But what about that monthly income that you're currently bringing in? And now you're going to not have that, or it's only going to be there for a couple months after you've paid off these things. Your expenses are lower once they're paid off, great. But you still need that income at least for a year minimum, but you're probably going to want it for 3 years, because the odds of somebody who went from not working to then making the same amount as at the time the breadwinner of the family, you might not be making nearly as much as they were at that time. So you definitely want to make sure that's covered for the future if you don't want to just drastically change your lifestyle.
Yeah, no, that's good. Well, let's spend some time. I want to talk about some estate planning ways that you can use, some tax planning and estate planning ways to use. And then we're also going to cover, hey, wait, can life insurance help me cover for way down the road long-term care costs? So for our retiree clients, hey, is it a good way to cover long-term care costs? But want to touch base on tax money. Tim, me and you were in Topeka recently, speaking at a conference to financial advisors on life insurance. And one of the things that we've really been looking at closely, it took me a while to, because again, I am very analytical when it comes to whatever we recommend to one of our clients, I've got to fully believe in it. And so for years, I didn't like life insurance. I didn't like it as an investment. I looked at countless numbers of illustrations, and it always bothered me that, well, maybe we could do a little bit better in the market versus putting our money into this life insurance policy. But one of the things that clicked for me is when I stopped looking at life insurance cash value, which is the cash value is your premiums that you put into the policy and any growth that your premiums get. And I started, instead of looking at the cash value, I started looking at the death benefit. Because to remind our listeners, if I have a life insurance policy, let's just say it's $1 million life insurance policy, and God forbid something happens to be, does my family, does my wife or my kids, my beneficiaries, do they pay tax generally when they receive that life insurance money?
That life insurance money that they get, tax-free. It's no cost, and it's also pretty quick to get it. Just sadly had a client there, their spouse passed away. They had a life insurance policy. Didn't like the situation, but we were able to just get the paperwork from the insurance company filing the claim of death, and they're just getting a check in the mail going to them here in the next week or so. And then it's tax-free.
Yeah. $5 million tax-free. Obviously, as long as it's under the estate tax exemption limits, which for a husband and wife are, well almost $30 million that you can pass on. Anything under those amounts, life insurance is completely tax-free to your kids and your beneficiaries. And so that's an angle of it. When we started to look at this, one of the things that we've been doing a lot, so tax rates right now are the lowest that they've been in 50 years. So based on the 2017 Trump tax cuts, President Trump lowered it from high income taxes, middle class taxes, low income taxes, corporate taxes as well. So tax rates are the lowest that they've been. So one of the things that we've been doing at Nicholas Wealth Management is with Tim, you and Aaron Jones, our CPA here at the firm, is if you have money in an IRA that's completely taxable, taking money out of that IRA and converting it to a Roth IRA. So when I convert money from my IRA to a Roth IRA, I pay taxes. I know it's not fun paying taxes, but again, taxes are the lowest that they've been in over almost 50 years. So I'm good to pay taxes today. That money can go into a Roth IRA. Roth IRAs grow tax-free. But I'll just give you some simple math. Let's just say I've got $1 million in my IRA, and I'm going to convert $500,000 of it, and I'm going to do it over the next 10 years. So if I do my math, $500,000 is $50,000 a year for 10 years. So I can take that $50,000 and I can put it into a Roth IRA. Or one of the other options, and again, you can do this if it's $1 million IRA and you're converting $100,000 a year, I could put $100,000 each year into a Roth IRA. But one of the things that we've been doing is a split tax strategy. And so take $1 million, for example. If you're converting $100,000 a year for 10 years, I've got $1 million in my IRA. 100 is coming out every year. So if I put that 100 into my Roth, how's that 100 going to perform in my Roth?
It'll have growth, tax-free, hopefully, but that's still going to fluctuate. It's not guaranteed.
And we're owning stocks, investments inside of it.
So you can put it in there, feel safe, but what if you didn't put all of it into leave all of it in the Roth?
Exactly. So one of the things that we've been doing, and if you want to explain the split strategy, is actually for the clients where it makes sense. Instead of all of it going to the Roth year 1 through 10, what if we split that into 2 separate payments? $50,000 into the Roth, and then if you want to talk about $50,000 going into a type of insurance policy that provides some really great benefits.
Yeah, so that other $50,000 for the original $100,000 being converted, put that to an IUL, indexed universal life insurance. You're gonna have that a guaranteed death benefit. So day one, first time you pay that premium, you've got a guaranteed death benefit of. Typically, it's like 1,000% growth from what you initially put in. It's huge. Heaven forbid anything happens on day one, but that's a great return that we can guarantee you. Whereas with that other $50,000 in the Roth, if we just left all of it there, like we said, it's not guaranteed. It's going to fluctuate. We're hoping for that growth every year. But with the IUL, you've got the tax-free death benefit if something were to ever happen. And along with these policies will sometimes come great riders. And we'll talk about long-term care in a minute. And that's one of the things that can come along with it. But it just has a lot of opportunities for what you can do with that IUL.
Because I just pulled up a policy that we did for a client. So this is for a female age 66 years old. And so it's a $50,000 a year premium payment for 5 years. So that means $50,000 a year will go into this policy for 5 years. So $250,000 total in this policy. This is what blew me away. And this is what really changed my opinion on these types of policies. $50,000. So I put in $50,000 to the policy. My day one death benefit, I'm reading this number, Tim, tell me if this is right. Day one death benefit, $792,000 is my day one death benefit. Is that right?
It's amazing. Yes, it's amazing. And so being able to say, hey, you're protected. You get to sleep safe at night knowing something happens to you, your spouse, your kids, your house, all taken care of, and you're going to have that money that's available for income. In addition to if you're retired, Social Security, if you're still working, you got your income. But it's huge. It's an incredible opportunity of what you can do as a guarantee.
Yeah, and I'm looking 10 years out. So at age 76, God forbid if something were to happen to her, $792,000 of death benefit. Now, and here's what's interesting, the cash value in the policy is only $309,000. I say only, and obviously this is not guaranteed. It's assuming an interest rate based on the growth of the market. But I put in $250,000, and in year 10, it's worth $290,000 cash value. That was the part why I never liked these. Because wait a second, I put $250,000 into this insurance policy. 10 years later, my $250 is only worth $290. That's a rate of return of less than 2% per year. I'll put it under my mattress for 2% per year. But I was looking at the wrong thing. What really should I be looking at here?
The death benefit. I mean, that's what you want to look at, is how big is that death benefit. But the cash value, most of the time with who we're working with now, it's older clients that we recommend and look at not touching that cash value. You have the opportunity of taking out as a loan and using it if you want, but it's just something we don't recommend. It's going to reduce that death benefit as you take out money. You don't have to pay it back. You can to increase that death benefit back up, but we just don't even really pay attention to that column. We don't talk about those numbers much because we don't need to look at that, because we want to look at the death benefit. What are you actually going to be getting? What is the reason for this policy? Is that?
Yeah, because I'm just looking at this. So the rate of return on that death benefit or after 10 years is an annualized rate of return of 15% annualized rate of return per year on that money. So again, we don't buy these planning, God forbid something is going to happen to us, but God forbid something does. These insurance policies can be a great way to hedge a Roth conversion or a tax conversion strategy. Because again, I put $50,000 into my Roth. Unless my Roth averages 15% per year for the next 10 years, I'm not going to be able to beat this insurance company. Even at 20 years, the internal rate of return of the death benefit is close to 7%. So a 20-year rate of return for this policy is still well over around 7% for the death benefit. That's not a guaranteed thing in the market. I mean, the market has done well the last few years, but who knows what the next 10 years is going to bring. And so that's why I say you shouldn't have all of your eggs in one basket, but being able to diversify your estate, I like ways that you can pass money on to your beneficiaries tax-free. I mean, that's really what I like. This is another way to do that, which I think is very interesting. Now, we can also get into some more advanced estate planning and say, there's also strategies that if you want to get money out of your estate, meaning, hey, David, I'm a high net worth investor and I've got, net worth of 30 million plus. I know it's not everybody, but there are some like athletes and business individuals that have sold their businesses. You can also utilize life insurance inside of a trust to where the death benefit, the beneficiary can be a trust that's out of your estate that can receive the life insurance proceeds, and it's not taxable to your estate. So there's really some good benefits to these policies that if you are considering, hey, David, what's the best way I can protect my family, but also be able to give my estate a really nice health from a tax standpoint, these policies can do really well. So men versus women, health-wise, women live longer. How does that all play into the cost of what might be more expensive or less expensive for life insurance?
Yeah, so looking at life insurance, they just expect men to die earlier. So female policy is typically going to be a higher death benefit than the men just because they're not expected to live as long. So that money that the insurance company has isn't able to grow as long. Age is going to then obviously make a difference as you get older. The premium is either going to increase or the death benefit is going to decrease. I'll tell you a number that we like to look at is basically if you're under 75, yeah, we can look at an IUL life insurance plan for you. After that, we're going to start looking, compare the numbers, and it's going to get a little more gray area. But between men and women are going to have a better policy. Sometimes it can be a strategy there of, okay, let's get a policy for the man, assuming potentially to die earlier than the wife, and he passed away. Well, that ends up being money for her that she can have for long-term care. She can have for any other needs that when he's not here, if the situation plays out like that and they didn't have this policy, she doesn't have those benefits, that money, that opportunity, the protection for the rest of her life. So looking at it from man to woman or joint policy, there's multiple options and scenarios on what you want to compare there. But with the joint policies, that's typically also going to be a little bit higher than it would be even for a female. But sometimes it doesn't necessarily make sense to do a joint policy. So it's things we like to compare, analyze what your situation is, and get specific for your needs.
So now we talked about life insurance for young individuals. If you're young and you want to provide for your family, term life insurance is the way to go. Life insurance when it comes to estate planning for tax-free estates. We know the death benefit of life insurance goes completely tax-free to your heirs. And if we're talking about our beneficiaries getting something tax-free, I'm not worried about cash value. I really want the highest guaranteed death benefit that I can get that goes tax-free to my heirs. But really, now let's talk about healthcare a little bit, because when you ask a lot of individuals what their big fears are financially, running out of money's usually number one, but number two is covering my healthcare expenses at some point in life, whether long-term care. We looked at this, Tim, you mentioned this before, how the cost of healthcare is just skyrocketing.
Oh yeah. I mean, in the next 20 years, it's expected to roughly double. That's expensive.
And I think CPI, average inflation, has been about 2.5% over the last 20 years. Healthcare has grown at 5% over the last 20 years. So the cost of, as bad as inflation has been, the average of inflation over the last 2 decades, healthcare inflation, expenses related to healthcare, long-term care, they've grown at twice the price of inflation, which is, so any of you that are in the medical profession, like, my sister's a physician. I know we've got advisors here, family members are in the medical field. We see it, right? Costs are going higher. And so especially on what we call aging care, which is long-term care centers, assisted living centers. I was looking at some numbers here. So this is in Atlanta. The average cost, if you want at-home care, it's about $5,800 a month to have someone come to your home. Assisted living is about $4,600 a month. If you want a private room at a nursing home, that's over $8,000 per month for a private room at a nursing home. So that's not cheap, right? Over $100,000 a year. But that's just today. So again, we'll use a 3% inflation rate, but 20 years from now, at a 3% inflation rate, you're looking at, for a assisted living, which is about $4,600 a month today, almost $9,000 per month which is just what you said. Over the next 20 years, the cost should double. $4,500, $4,600 today, almost $9,000 20 years from now. That's at 3%. What about this is going to be painful.
Oh, it's going to hurt.
Yeah, 5% inflation rate for an assisted living facility today in Atlanta. It's $4,600 a month. But if the cost of long-term care and nursing home expenses grow at the same rate that they have for the last 20 years, which has been 5%, the cost in 20 years for an assisted living facility would be $13,000 per month. If you want a private room at a nursing home in 20 years, $25,000 per month for a private room in 20 years, if costs keep going the way they're going. So that's insane. So I see, Tim, why a big fear for investors and some of our clients could be, how am I going to cover these long-term care costs? It's a big deal.
Yeah. So looking at those long-term care costs, I mean, how are you going to pay for that? If you even said what it is today, some people are saying, how could I pay for that even today? So, hey, let's get you some protection with a long-term care policy that is going to give you money every month to be able to pay for this. It might not cover the full amount. It might not be getting you $25,000 a month. But hey, if you're looking at the $15,000 a month place, well, if you've got $10,000 a month coming in from there, well, you've also got Social Security. Maybe you've got investments you need to dip into a little bit. You're also going to potentially, if you're moving there, paying that, you're going to potentially sell your house. That's a couple extra funds that you can use to pay for it. But it's a lot better having that policy and that safety and security, knowing this is that I'm getting every month from them. That's helping me pay for this, and I'm not going to run out of money really quickly because I'm paying $10, $15, $20, $25,000 a month, which is just huge. Because, you might have a good size house and a good size IRA, but if you're taking that out each month and paying taxes on it, that's going to go away pretty quickly.
Yeah, especially with market volatility and taxes. So I think one of the challenges also that many investors has is you may have had one of these long-term care policies that the premiums go up every year, and the premiums go up to the point where the insurance company is almost saying, I don't want to insure you. So you bought this policy at 10 years ago thinking you're only paying $300 a month or whatever the number, $200 a month. And now you could be paying $500, $600, $700 a month for the same policy. So what is it that we do a little bit different when we're looking at long-term care? Can you give us an example of, hey, for an average person, what would they be paying into it, and what would the benefit they would receive at, say, 85?
Yeah, so it's structured pretty similarly to the life insurance policies, because it is actually going to have a death benefit, which we'll get into in a bit.
So these are called what, like hybrid policies then?
Yes.
Hybrid.
Yep. So it's an IUL hybrid policy because its main focus is going to be that long-term care portion. So we'll call it a 10K 10 pay. So putting in $10,000 for 10 years. That's going to be the premium that you pay. After that, covered for the rest of your life. It doesn't ever lapse. It's guaranteed to pay till you're 120.
So you put $100,000 into the policy, but over 10 years. So $10,000 a year every year for 10 years, and that's it. No more premiums.
No more premiums.
So 100,000. That's it.
Yep.
Yeah.
You're locked in, and then the benefits, we structure it typically with a 3% inflation rider, so that every year, what the monthly benefits would be, increased by 3%. So it's going up, going with inflation. It's helping. That way, might be a okay benefit today, but in 20 years, you're looking at really good numbers. And I know we're helping somebody out, and they were, I believe, 65 years old, did a 10K 10 pay, and when in 20 years, he'll be getting about $9,000 a month. And no, that's not going to cover that $25,000 a room. But like I said, that's covering so much. Maybe he needs an extra $2,000, $3,000, $4,000 coming from Social Security, pension, anywhere else that he has to pay for it. But he's got every month paying out roughly $9,000 coming to him. And I will say one thing that I make sure to be clear about when I'm talking to people about this is how it gets paid out. Because the insurance company has options of either doing like a reimbursement or indemnity.
Yeah, this is interesting.
And the reimbursement, to me personally, sounds scary and just a hassle, because every month you're going to get your checks or your receipts, send that to the insurance company. I'm going to see how much it is, see what qualifies, and then send you a check each month.
So you have to
for that
pay all the expense in a reimbursement policy. You write the check personally to the long-term care facility, and then you submit that to the insurance company, and then they have to reimburse you with what you already spent. Got it.
So that just sounds like a lot of work to have to do each month.
No, thank you.
And if you're in that facility, you might not be able to physically just do that. But then, or you've got a family member who's good doing that, and you have to just rely on them for it. It becomes a hassle. Well, we like indemnity, which is the insurance company. Once you've triggered the policy to turn on, so you can't perform 2 of the 6 acts of daily living. That's walking around the house, feeding yourself, going to the bathroom, getting dressed. Once you can't do those,
perform 2 of those.
You can't do
Not
2 of them.
6, just 2 out of the 6.
Exactly.
Okay. That triggers the policy to start.
Turns the policy to turn on. So then there's going to be a short period that they won't pay you, but it's about 90 days usually. However, after the 90 days, they start paying you, and they'll reimburse you for those 3 months that you didn't get paid. And then from then on, every month, you're getting a check in the mail. For this guy, it'd be about $9,000. He's getting that check in the mail at age 85, tax-free. So not paying taxes on it. You're getting it every month, and you don't have to worry about, hey, here's a receipt. How much am I getting? What's it going to be? How much do I need to cover? You know what's coming in. You know what you're going to have to cover. You've got safety, security, peace of mind that you're not hesitant or fluctuating each month.
Because if you think about it, what is the average stay in a long-term care facility normally? I mean, the odds are you never want to be in a long-term care facility, but I know there's some data around, like, if you do have to go to a long-term care facility, is it a long stay? What is the average time generally?
Average is typically about 3.5 years. So for our policies, we typically structure them at 4 years for the term of the benefits. There are options to increase it to 5 years, 6 years, 7 years. And I have done that, of increasing it to 5 years for people. I don't really like increasing it to 6 years. It drops that monthly benefit a little bit by increasing the time. But it's just, hey, the odds of you needing it for that long aren't that likely. So let's get a little bit more money each month by having it for the 4 years or 5 years.
Yeah, that's interesting. So I was looking at policy here. This is for a male age 65 years old. When he's 85, it would pay out about $8,300 per month at age 85. But so that if he needs it for the full 4 years, that's $400,000 in total payouts that the policy would pay. So he put in $100,000 over 10 years. But if he needs it for the full 4 years, he gets $400,000 out of the policy. And again, we're financial planners, we're investment managers. At the end of the day, I want to know, is this still a good return on my money? If I'm going to put $10,000 away somewhere, well, why would I give it to the insurance company? Maybe I could just send it to us. We'll invest it. With David, can I get a better return? So what is the internal rate of return that we actually calculated? The rate of return on the $100,000 invested with $400,000 paid out when we're age 85, that's an 8%, 8.3% annualized rate of return. I mean, that is tough to argue. We don't want to have to be in a long-term care facility, but if we actually need it, the return that we're getting on our money that we put into the policy, it is pretty competitive. Where else can we get an 8% guaranteed rate of return? Again, nothing. Guarantees are probably by the claims paying ability of the issuing insurance company, but based on the guarantees of the policy, the rate of return is built in. It's about an 8% annualized rate of return. So that's the scenario if we go into the facility. Now, I tell this to all my clients too. Our prayer is that you never need this policy. I always say insurance is built and you hope you never need insurance. I get car insurance, but I hope I never have to use my car insurance. I get life insurance. I hope I never. The best thing would be that this life insurance expires and I never need it. Long-term care is the same way. We never need it. So alleviate the concerns a little bit, because if I put $100,000 into this long-term care policy and then I don't need it, I think the drawback to a lot of these policies were, I paid all this money into, or you may have family members, David, we paid all these years premium payments to these policies, and my parents never needed it. They passed away and they never needed it. It's great, but we wasted all this money in this policy. Can you talk me through that a little bit?
Yeah, that's what I like to ask. Have you ever had your car, paying car insurance, sell the car after 5 years, and then you never got in an accident, and you call up the car insurance company and say, hey, I sold the car. Can you pay me back my car insurance that I paid you because I never used it?
They should do that.
It'd be nice, but they don't do that.
Yeah.
Well, with these, how we structure it is you put in the $100,000. It's going to be right around, sometimes it's a little bit more than what you put into it, is still a guaranteed death benefit. So if you don't use it, no, it's not going to have a huge growth, but you're still getting money back. You're still getting everything you put in there back in return. You can't get that because it's still insurance and it's securing you for the future, but you can still get it back if you don't use it. So it's security for that long-term care, peace of mind. But hey, if I don't use it, I don't lose it. It's not a use it or lose it policy. It's you're still going to, like most insurances, if you use it, great. If you don't, too bad.
I'm looking here at this illustration. Yeah, you're right. It is more. So God forbid, if he passes away at age 85 and never needed the long-term care policy, the $109,000 would go back to his either wife or kids as a tax-free death benefit. And so you're exactly, put in $100,000, $109,000 goes back to his death benefit. That actually just reminds me, we had a client in the office this week. Wonderful client. He's been a client of mine for almost a decade. We had 2 policies, one for him and one for his wife, 4 of them structured exactly like this. Unfortunately, his wife passed away, so never needed the policy. But the death benefit was $175,000 that is now going back to the husband completely tax-free. And so again, it was there if they needed it. She did not. But at least those premiums were not lost, and there's still some benefit to the family for that premium payment.
Yeah. So, and it's a huge, nice benefit there. Well, what if they only use it for a year? Well, you still have that death benefit. It's just going to be dropping as you're using the policy. So, yeah, if you don't use the policy, you get that full death benefit. Great. If you were to only use it for 2 of the 4 years, well, now your death benefit, since you used half of it, your death benefit's just going to be cut in half. So instead of being that basically $100,000 or 110 in this case, it's going to drop down to $55,000. So you're still getting that death benefit. You're still getting a return of money that, one, when you use basically $200,000 by staying at the place for 2 years, and then you're getting another $55,000 as death benefit.
Yeah. That's a really good. So it's not even. Yeah, it's still that you're still gonna always get your premium payments back. What if I'm 5 years in and I change my mind? Hey, David, this is great, but I won the lottery. I'm a billionaire now, and I don't need this policy. It's going to pay me out some life insurance. Am I stuck, or do I have options there also?
No, you can still definitely surrender it and get out of the policy. It's going to cost you a little bit, or you won't be able to get your full premiums back, but you wouldn't be stuck in forced to do it. I will say with that, we've had people where we look at their policies. I won't name names of who the other companies are that they got it from 15, 20 years ago, but they come in and they're like, hey, I've got this policy. Either I've been paying for it or I don't know what to do with it. Should I keep it? Should I just take the cash value? And I'll say, hey, let me look at it. Let me just compare it to what we could do. What if we took that cash value, surrendered the policy, and put it into a new one? There's sometimes it's not as good and they've got a great policy. But I've seen several where, all right, increased long-term care, increased death benefit, and it's just your numbers didn't really make sense when you got this because they should look better. You were younger, healthy, you were putting in premiums, should have been better. But hey, I can just take that cash value, put it in a new policy, and you're looking great. So you're still able to surrender it. You're not stuck. But there are options to replace it if you didn't win the lottery and you're not a billionaire now.
Yeah. That's great. Wow. Well, it's really good stuff. And again, I know this can be very complicated dealing with life insurance and dealing with illustrations. It's one of the reasons why, Tim, I'm so excited that you really run our life insurance division here at the office, and you kind of really have taken ownership of that. And so it's really been great to know that you see all these different policies, because it's hard if you don't have a background in insurance to know, hey, what policy is better? Why is one better over the other? And they're not all the same, right? You could get illustrations from 5 different companies, and they could be maybe all over the place as far as the death benefit goes, as far as the premium payments go. This is why I say the other thing is it's good to be able to shop all the insurance companies. Like if you have I don't want to name names. I would never name names of other companies. Northwestern Mutual. Just kidding.
There you go.
Take Northwestern Mutual, for example. Hey, great company, but you're only getting a quote from one company. What if Northwestern Mutual is not the cheapest? And so we've seen that you can do a lot better than just looking at one company. You may look at 10 or 20 different companies, see what all the rates are, and then try to get the best rate. So I think it's important to maintain being competitive also in this landscape as well.
Oh, it's huge. And I mean, I've seen for some of the life insurance policies, a difference in death benefit of over $150,000 when compared same premium payments, just different companies. And they said, I'll pay $150,000 more.
Yeah.
That's a big difference to look at when not buying a policy.
Yeah. No, that's big. Well, good stuff today, talking about life insurance. Again, it's a topic that, it can be a little bit of a tedious, but life insurance can be a great way that if you're young and you have a family and you have a house, you got to have life insurance, but you want to do it in the cheapest way possible. That's generally term insurance. If you're someone that's approaching retirement or in retirement, or you've already maxed out most of your other savings opportunities, looking at life insurance with guaranteed tax-free death benefit can be a great estate planning tool to pass money on to your heirs. And then lastly, long-term care. We're not a big fan of traditional long-term care insurance, but by using these types of policies that give you a set premium payment and a guaranteed death benefit, or a way to guarantee cover your long-term care expenses, can be a tremendous tool. So let us know if you have any questions on that. You can always go to our website, nicholaswealth.com, or you can give our office a call, 404-890-5606. We're here to answer your questions. Tim, thanks for being with us today on the RetireReady Podcast. It was great having you.
Thank you so much for having me.
Yeah, I have a feeling you'll be back, man.
I hope too. I look forward to it.
Awesome. All right, guys. Well, thanks for joining us again. We'll hopefully see you here soon for another episode of the RetireReady Podcast. We'll see you then.